In today's fast-paced and data-driven world, businesses rely on technology more than ever to manage their financial records. Regardless of whether a business is a small startup or a large corporate, computerized systems are crucial for delivering accuracy, speed, and compliance when it comes to processing financial information. And this is where computerized accounting systems come in. These digital accounting systems replace traditional paper records, allowing businesses of all different sizes to record, process, and report their financial transactions with speed, accuracy, and confidence. From sending invoices to generating real-time financial reports, technology has transformed the way organizations are managing their accounts, saving them time, reducing errors, and supporting better decision making. In this section of the material, we're going to explore how digital accounting software works, how cloud computing is revolutionizing data access, and how artificial intelligence is changing the future of bookkeeping. So what exactly is a computerized accounting system? In simple terms, a computerized accounting system is a digital software-based tool that helps businesses manage their financial transactions. These computer-based systems help record, process, and report financial information automatically, replacing the need for handwritten ledgers and calculators, which were commonplace in the past. Old school, manual, paper-based accounting methods, while still used in some small organizations, come with serious limitations. They're slow, time-consuming, and prone to human error, meaning it's easy to make mistakes, and they make it hard to spot trends or generate useful reports. Computerized systems solve many of these issues. They reduce the risk of human error, speed up repetitive tasks like posting transactions, and they ensure faster access to data and provide instant insights into a business's performance, which allows for faster and better decision making for managers. Simply put, they make accounting far easier and much faster. Gone are the days of huge physical ledgers and books and manual calculations. Almost all modern businesses rely on software that brings automation and intelligence to their accounting functions. So, how does a digital accounting system actually work? Like any information system, a computerized accounting system operates through a clear workflow. The three key stages are inputs, processes, and outputs. First, we have inputs. These are all of the raw pieces of financial information that a business needs to capture, such as receipts, invoices, payroll records, bank statements. These documents, which include source documents, standing data, and transactional data, tell the story of what the business is buying, selling, earning, and spending. In a computerized system, these inputs can be entered manually or increasingly imported automatically from connected systems within the organization. Next comes the second step, processes. This is where the real accounting magic happens. The system takes those inputs and processes them using a set of built-in rules. Transactions are recorded in ledgers and journals. VAT is calculated, payments are matched to invoices. It might even highlight missing data or errors for review. These steps ensure accuracy, consistency, and compliance with financial regulation. And then finally, we move to outputs. This is where things get really useful. Once all the information which has been inputted into the system has been processed, the system can generate a wide range of financial reports, like the trial balance, the income statement, and the balance sheet. These reports give business owners and stakeholders a clear snapshot of the company's financial health and its performance. So in short, a computer-based accounting system is a powerful engine that can turn everyday transactions into valuable financial insights. With just a few clicks, you can go from piles of paperwork to professional financial reports. Accounting software packages are computerized systems that help businesses record, process, and report on their financial transactions. They replace traditional manual paper-based accounting systems with digital ones, making the processes faster, more accurate, and easier to manage. These accounting packages come in many different shapes and sizes. You have the off-the-shelf solutions that you're probably familiar with, like QuickBooks or Xero, which are ideal for small businesses. They're affordable, easy to use, and cover all of the basics. However, more complex businesses, such as large corporates, often use more bespoke systems, which are customized to fit their unique processes and workflows. These systems can handle complex data from across multiple departments and integrate with other enterprise tools. Many providers offer a modular approach, allowing companies to add features like payroll, inventory management, or tax compliance over time as and when needed. The beauty of a modular structure is that businesses can choose the products that they need and scale up as they grow. One major advantage of computerized accounting systems is integration. These systems are not only faster and more accurate than manual bookkeeping, they also integrate with the business's banking apps, CRM systems, and even AI-driven forecasting tools. This reduces duplication and ensures that everyone within the organization is working from the same up-to-date data. Overall, accounting software packages not only improve accuracy and save time, they also help businesses meet regulatory requirements and gain better financial insights. Cool. Standing data. Standing data is one of the quiet heroes of any computerized accounting system. It refers to fixed background information that the accounting software uses repeatedly to support the recording of the business's day-to-day transactions. Standing data includes things like customer details, supplier records, supplier addresses, VAT codes, employee details, product descriptions, and ledger account numbers. Because this information doesn't change very often, that's why we call it standing data. Once the data has been recorded by the business, the system reuses it automatically every time you raise an invoice, record a payment, or generate a report. Recording data as standing data not only saves time, it also improves accuracy, consistency, and ensures efficiency across all of the business's accounting processes. Cool. And when it comes to recording transactions in an accounting system, timing really matters. And that's where real-time and batch processing come in. Real-time processing means each transaction is recorded instantly as it happens, whether it's a sale that has just taken place or an invoice has just been received from a supplier. A real-time accounting system will update the nominal ledger straight away. Real-time processing gives you up-to-date, up-to-the-minute reports and insights perfect for fast-paced business environments. Batch processing, on the other hand, groups transactions together and enters them at a scheduled time. Therefore, transactions are not going to be processed immediately. It's often used in situations where data is collected throughout the day and processed at the end of the day, like after-hours banking or payroll processing. While batch processing offers more control over when data is posted, it can often delay reporting. Real-time systems, in contrast, give immediate visibility into your business's performance. It's instant. While batch methods are used in certain contexts, most modern accounting systems now operate in real time to support immediate access to useful, updated financial information, and we will focus on real-time processing for the purposes of our studies. Cool, let's now dive into cloud accounting. Cloud accounting is a way of using the internet to access and manage your accounting data. Instead of installing software on your local computer or keeping financial records down on paper, everything lives securely on remote servers. This means as a business or as an accountant, you can access your accounts anytime, anywhere from a laptop, a tablet, or even your phone. So one of the main advantages of cloud accounting is flexibility. Whether you're working from the office or at home, you can view your financial data in real time and make updates almost instantly. This real-time access helps businesses make quicker decisions and collaborate with accountants far more easily. One of the big considerations, though, regarding cloud accounting is that it relies on a stable internet connection. If your internet connection drops or your provider experiences an outage, you could temporarily lose access to your data. And there are also security concerns. Your financial data is stored off-site, and while providers offer robust security, businesses must trust that their data is protected against cyber threats, and they've got sufficient protection against cyber threats. Despite the risks that are attached to cloud accounting, the benefits tend to outweigh the costs. You can realize cost savings, access scalability, and integrate your accounting systems with other systems within the organization. That's why more and more businesses are turning to cloud accounting as the future of their financial reporting. Businesses and users can access cloud-based technology in many different ways, depending on their needs. And that's where the three main cloud service types come in. You've got software as a service, platform as a service, and infrastructure as a service, or SaaS, PaaS, and IaaS for short. Let's start with software as a service, or SaaS. This is the most common type of cloud service and the one you've probably used before without even realizing it. It's where you use software over the internet, just like you'd use a website, instead of having to install it on your computer. You don't need to buy, download, or update the software. You simply just log in through your browser and start using it. The company owns the software. They handle all of the behind the scenes work, like the updates, the backups, the security. When you think of SaaS, think of things like web-based email, like Gmail, accounting software like Xero, QuickBooks. These are all examples of high-profile SaaS businesses. You log in, do your work, and everything is saved and backed up online. SaaS is ideal for businesses that want simple, ready-to-use applications without worrying too much about the underlying tech. Next, you've got platform as a service, or PaaS. This one's a little bit more technical. PaaS gives developers a ready-made platform to build their own apps without having to worry about setting up servers or managing their hardware. Services like Microsoft Azure or the Google App Engine fall into this category. For example, if a business wants to build a custom invoicing tool tailored to their workflow, a PaaS could provide the environment to help them do just that. Finally, we've got infrastructure as a service, or IaaS. This is the most flexible type of service. IaaS gives the user access to virtual hardware over the internet without them having to own or maintain a physical machine themselves. It's like renting a data center basically, but without actually owning one. So AWS and Microsoft Azure are high-profile examples of businesses that offer IaaS solutions, and the model is ideal for businesses that need to scale up quickly or run complex systems but don't want to invest too much capital in physical infrastructure and hardware. So to sum this slide up, SaaS is for businesses that want to use ready-made, ready-to-go software. PaaS is for developers who are building apps, and IaaS is for businesses that want full control over virtual hardware. Cool, so here we've got a sample exam question. Let's run through it to test your understanding of the last couple of slides. So which of the following is not an example of a cloud computing service? Option A, an online platform that lets users collaborate on documents in real time. Option B, an accounting software accessed through a web browser. Option C, a desktop application that stores data only on the local hard drive. Or option D, a customer relationship management tool accessed on the computer of users. Cool, so the correct answer to this question is option C. This is because desktop applications that store data only on the user's specific hard drive doesn't rely on the internet or on remote servers, meaning it's not cloud-based. In contrast, the other three options, A, B, and D, all involve services that are accessed and managed online. Moving on from cloud accounting, let's discuss artificial intelligence. In simple terms, AI refers to a computer's system's ability to perform tasks that would normally require human intelligence. This includes things like recognizing speech, making decisions, solving problems, language processing, recognizing patterns, or even learning from experience. Unlike traditional software, which follows a fixed set of rules, AI systems can improve over time by analyzing data and adjusting their behavior, making more informed decisions. The ability to learn, adapt, and improve is what sets AI apart from other forms of technology. And you're probably more familiar with AI than you even realize. Voice assistants use AI to understand and respond to your commands. When Netflix suggests what to watch next, that's AI. When your bank flags a suspicious transaction, that's also AI. Or when you chat with a support bot on an online website, that's also artificial intelligence at work. So AI is no longer a futuristic idea. It's already embedded in our daily lives, and it's beginning to transform entire industries, including accounting. So yeah, AI is changing the way that accountants work. Traditionally, accounting tasks like data entry, reconciliations, or expense categorization took accountants hours. They were highly repetitive. But now, AI can handle many of these mundane tasks automatically, saving valuable time and reducing the risk of human error. For example, AI-powered systems can automate data entry by extracting key details from scanned invoices, receipts, or bank statements, and enter them straight into a business's accounting system. AI can categorize expenses into certain accounts, such as purchases, administrative expenses, marketing expenses, just by recognizing patterns from previous transactions. And AI learns over time, becoming more accurate the more it's used. AI can reconcile accounts, comparing what's in your accounting records with your bank statements, and flagging any mismatches instantly. One of the most powerful uses of AI is in fraud detection. It can identify unusual activity or transactions of an unusual size that might be missed by the human eye, like duplicate payments or unexpected patterns in spending. AI can generate reports, such as income statements or cash flow summaries with little to no manual input from the accountant, freeing up bookkeepers' time to undertake more detailed, complex analysis. And on the client side, chatbots powered by AI can answer common accounting questions posed by clients to their accountant, and they can answer those questions almost instantly, offering 24-hour support to clients of accountants. So with all of this in mind, AI helps accountants move away from repetitive data tasks, allowing accountants to spend more time offering insights, conducting analysis, and offering strategic advice to clients. While AI offers many exciting possibilities for the accounting profession, it's also important to be realistic about its limitations. First, the costs of AI-powered systems can be really high. Advanced software, cloud-based tools often come with high subscription fees, high implementation costs, and training requirements for staff, which may be a significant barrier for smaller firms. AI may perform well when it comes to quite routine transactions, but it can struggle when it comes to non-standard or complex transactions. These complex cases still require human judgment, experience, and context, things a machine can't really easily replicate. Another challenge is that AI systems are only as good as the input data they're provided by the human accountant. If the input data or training data they're provided is incomplete, inaccurate, or biased, then the outputs and the decisions based on them could be pretty flawed. And finally, security is another major concern. AI systems process very sensitive, confidential client financial information, which makes them attractive targets for cyber criminals. If not properly secured, these systems could expose a lot of confidential information. So the key takeaway from this slide is that AI is a tool, and it's not a replacement for human expertise. It's ideal for repetitive tasks like data entry, reconciliations, but it doesn't replace the need for professional oversight and good judgment from human accountants. Cool. Let's walk through an exam question. Which of the following tasks is least suitable for artificial intelligence in accounting? A, spotting duplicate transactions across thousands of records. B, analysing business risks in a large one-off transaction. C, identifying long-term spending patterns from expense data. Or D, reconciling bank entries with corresponding sales invoices. So the correct answer to this question is option B. While AI is super powerful, it struggles with tasks that require human judgment, especially those that involve nuance, complexity, or are one-off in nature. Analysing business risk in a unique transaction often calls for professional insight, industry experience, and an understanding of the context, which AI systems simply can't really replicate. Okay, so let's look at why the other options are wrong while we're here. Option A is wrong because AI is actually really good at scanning huge data sets for duplicates. It's fast, it's accurate, and it's really ideal for executing repetitive tasks. Option C is also incorrect. Spotting trends, patterns in spending is exactly kind of the task that AI was built for. And option D, finally, is also incorrect because AI can reconcile bank entries with invoices efficiently, flagging in mismatches or anomalies much faster than any human being could. So remember, when the task calls for judgment and contextual thinking, like in option B, AI should never be used. You should still rely on a human being and an in-person accountant. Cool, so in this section of the material, we're going to focus in on source documents. A source document is a piece of evidence that shows that a financial transaction has occurred. It could be a receipt for a cash sale, a credit note for a refund, or an invoice showing that money is owed. So it could be any of these physical documents. These documents can come in either paper-based format, they can be in electronic format, depending on how the business operates. A printed sales receipt, a digital invoice, email to a customer, or a PDF bank statement are all examples of source documents. And in accounting, source documents are absolutely vital. They're the inputs that feed into an accounting system. They provide the information that the accounting system needs to be able to record each transaction that a business undertakes accurately. And without reliable source documents, we can't be confident that the financial records reflect what actually happened within the business. That's why they're such a critical part of the accounting process. Cool, so let's look at some of the information from an example source document that's contained within a source document. So imagine a business sells goods to a customer on credit. The source document here would be the sales invoice, which is issued to the customer upon sale. The system will record the sale amount as revenue on the income statement, and the amount owed by the customer will be entered as a trade receivable on the balance sheet. If there's any VAT on the sale, that will be calculated and recorded separately, as will any trade discounts given to the customer. Later on, when the customer makes a payment, the system will record the money received as cash and reduce the outstanding amount, the trade receivable. So remember, the accounting systems aren't just filing copies of documents. They're capturing the financial effect of each transaction to ensure that the business's financial records stay up to date. Let's now walk through the 4 key steps when a business sells goods to a customer on credit. And most importantly, we need to look at the key documents that are issued at each stage of the process. So step one, the customer places an order. At this stage, the seller prepares a sales order document, which highlights and documents the goods or services to be transferred and the agreed price. The document helps the business keep track of their orders, but since it doesn't confirm that a transaction has taken place, it's not considered a source document for recording financial transactions within an accounting system. It's not a source document. Step two, the goods are dispatched. At this stage, a delivery note prepared by the seller is included with the shipment of the goods. It sets out what goods have been delivered, in what quantity, to which delivery address, and also the date of delivery. Again, it's a useful document for both parties to confirm the delivery, but again, it's not a source document. It's not a source document. Step three, the sales invoice is issued. This is the critical step from an accounting standpoint. The invoice tells the customer how much they owe and when it must be paid. It serves as formal evidence of the transaction, and it's recorded in the accounting system as a source document. And then finally, step four, payment is received. The customer makes the cash payment, and this is matched against the invoice to close off the balance. So throughout this process, the invoice is the key piece of evidence from an accounting perspective. It tells the system that a transaction has occurred between business and customer and needs to be recorded within the accounting system. Okay, so now let's look at the four key steps involved when the business purchases goods from a supplier on credit. Step one, the business identifies goods that they want to buy and they send a purchase order to the seller. A purchase order document outlines what the business wants to buy, including the quantities and the delivery details. The supplier will respond by issuing a sales order, which they'll send to the buyer, and it outlines the terms which align with the purchase order. So importantly, a purchase order is not a source document. Step two, the goods are physically received by the business. When the delivery arrives, the business raises a goods received note, or a GRN as it's commonly known. This internal document confirms what was actually received before any payments are made. And again, while it's vital for internal control purposes, a GRN is not a source document either. Step three, the supplier invoice is received. The invoice is a formal request for payment and includes the total amount due and the payment deadline. It acts as a source document and is entered into the accounting system to record the liability on the balance sheet, which is the amount owed to the supplier. And then finally, step four, payment is made by the business. Once the invoice has been reviewed, the business pays the supplier. The payment is recorded in the accounting system and the outstanding balance is settled. Cool, so just like with sales, while multiple documents are created in the process of purchasing goods from a supplier, it's the invoice that is the source document and the key document that we need to be aware of as accountants. So, to summarise, the key point that I really want to stress from the past two slides is that invoices are absolutely critical to the accounting process, especially when it comes to credit transactions. An invoice acts as a source document, which is proof that something has been sold or bought on credit and that money is now owed. So it's evidence that a transaction has taken place. So to summarise, a sales invoice is issued when a business sells goods or services on credit. It's sent to the customer and records how much is owed to the business by the customer. It's used to update revenue, output VAT, and trade receivables in the financial statements. On the other side of the coin, purchase invoices are received when the business buys something from a supplier on credit. It records what the business owes and is used to update expenses, input VAT, and trade payables. So invoices aren't just paperwork. They provide evidence that a transaction has occurred and are the trigger for the accountant to record a sale or purchase in their accounting system. So let's look at the typical information that you find within an invoice, whether it's one you send to a customer, a sales invoice, or an invoice you receive from a supplier, which is a purchase invoice. So first, every invoice needs to include a unique invoice number. This helps both parties track and reference the transaction. It will also include the names and addresses of both the business issuing the invoice and the one receiving it, the seller and the buyer, as well as the date that the invoice was created. Then comes the detail of what's being charged for. We need a clear description of the goods and the services that are being transferred, as well as quantities and the unit price. If any discounts apply, like trade or bulk discounts, these should be shown too in the invoice. The total amount due, the invoice amount, including any VAT, needs to be clearly illustrated in the invoice along with due dates, so the customer knows when their deadline to pay is. And crucially, the invoice should also include bank details or account information for making the payment. So whoever the party is that is making the payment needs to know who they're making the payment to and where they need to send the money. And some invoices include remittance advice slips, which the customer can return with payment as confirmation. So all this information ensures that both parties are clear about what was bought, for how much, and when payment is expected, making the invoice a vital document for recording transactions. A credit note is issued by the seller when a customer has been overcharged or returns the goods that they purchased. So it's essentially a negative invoice that reduces the amount that the customer owes to the supplier. For example, if the wrong item was sent out or the price on the invoice was incorrect, the customer had been overcharged, a credit note needs to be issued to correct the error. In accounting, a credit note is a source document. It provides the evidence an accountant needs to update the customer's balance and the business's records. It's entered into the system just like an invoice, but it has the opposite effect. Alongside credit notes, there are debit notes. These are typically issued by the customer. It's a formal request to the supplier to issue a credit note, often in response to a problem with the original delivery or invoice. It's important to flag that a debit note is not a source document. Both credit and debit notes are important tools for managing and correcting credit transactions, ensuring the accounting records for credit transactions are accurate and fair for both parties, but only the credit note is a source document, the debit note is not. So let's see how a credit note works in practice. Imagine a business sells goods to a customer for £500 plus £100 worth of VAT, bringing the total amount to £600. In this case, a sales invoice is issued and recorded in the accounting system. A few days later, the customer returns some goods worth £100 plus £20 worth of VAT. To reflect this, the seller needs to issue a credit note for £120. So in the accounting system, this will act like a negative invoice. It reduces the amount owed by the customer from £600 to £480 and adjusts both the sales revenue and VAT liabilities accordingly, reducing them both. This ensures the accounts reflect the true value of the sale after the goods have been returned. The credit note is recorded as a source document just like the original invoice because it directly affects the business's financial records. Cool, let's now look at a practical scenario involving source documents. Greenfield Furniture Limited sells £2,000 worth of office desks to a customer, Hawthorne Design Studio, on credit. A few days later, Hawthorne returns £300 worth of the goods. The question we need to answer is which two documents would act as source documents in Greenfield's accounting system for the transaction? Is it A, a delivery note and a credit note, B, a sales invoice and a delivery note, C, sales order and a GRN, or D, a sales invoice and a credit note? So the correct answer for this question is going to be option D, the sales invoice and the credit note. The sales invoice is the source document that records the original transaction, which highlights the amount owed by the customer for the sale. And when Hawthorne returns part of the order, Greenfield will issue a credit note to them to reduce the balance which is outstanding. The credit note is also a source document because it affects the business's financial records. Documents like delivery notes and sales orders are pretty useful operationally, but they're not used as the basis for accounting entries. They're not source documents. So remember, it's the invoice and the credit note that are the source documents for accountants. Everything else is not a source document. In this section, we'll introduce the concept of electronic banking and discuss how it has transformed the way accountants record financial transactions. So in the past, businesses heavily relied on their cash book to manually record payments and receipts, a process that was slow, prone to errors, and often done only once a week or at month end. With the rise of electronic banking in recent years, that's changed completely. Businesses now have real-time access to their bank accounts and can update their accounts and their records much more regularly. Many modern accounting software packages connect directly to their business bank accounts, allowing transactions to be automatically imported into their accounting system. Of course, not every transaction that involves a business bank account is immediately recognised. When the system encounters a transaction it can't match or can't categorise, it temporarily posts that transaction to the suspense account. Once the correct details are identified, the transaction is posted to the right account and removed from the suspense account. The seamless integration of bank account and accounting system not only saves time for accountants, but it also greatly improves the accuracy and timeliness of financial records. In accounting, the cash at bank account is a key nominal ledger account used to track all activity in a business's bank account. It records every time money comes into the bank, such as when a customer pays an invoice or when a refund is received, and every time money goes out of the business, like supplier payments, payments for wages or utility bills. So the balance on this account represents how much cash the business has available in its bank at any one time. And because this money belongs to the business, the cash at bank account appears as an asset on the balance sheet. A cheque is a piece of paper that tells a bank to pay a specific amount of money from one person's account to someone else. In accounting, when a business writes a cheque, it records the payment immediately in the cash at bank account, even though the funds may not actually leave the bank for a few days. When a business receives a cheque, it records the payment when it's received or deposited, usually as income or as a reduction of a customer's outstanding balance. Cheques typically take 2 to 5 working days to clear, which means that there's a delay before the money is reflected in the bank statement balance. And because of this delay and the rise of faster digital alternatives, cheque use is now declining. Most modern businesses prefer electronic payments and electronic bank transfers because they offer speed, reliability, and accuracy. Petty cash is cash in the form of notes and coins kept in the business in order to make small ad hoc payments, typically for everyday items like postage, refreshments, or office supplies. The petty cash book is a simple manual record used to track small cash payments made by the business. It works alongside the main accounting system and helps control these low value, everyday routine expenses. Each entry in the petty cash book records the date, the amount spent, the purpose of the payment, and any related receipt or reference number. While it involves physical cash rather than bank transactions, the petty cash book plays an important role in maintaining a complete and accurate picture of a business's spending. Cool, so let's look at a sample exam question. Rani downloads a report of her bank transactions for the day and notices a £200 payment listed on her business account. However, when she checks her accounting software, the system can't match the payment to an existing transaction. This raises a key question for us as accountants. What could this unmatched payment represent? So if we look at the options, could it be a refund received from a supplier? Could it be a credit sale made to a customer? Could it be the settlement of an electricity bill by direct debit? Or is it perhaps a loan repayment received from a staff member? So the correct answer here is C, the settlement of an electricity bill, because that is the only payment being made by the company here. Everything else is a receipt. A refund received from a supplier is cash coming into the business. A credit sale made to a customer will lead to cash coming into the business, and a loan repayment received from a staff member will also lead to cash coming into the business. So C is the correct answer here. The other three options involve cash coming into the business, whereas the payment of an electricity bill by direct debit leads to cash flowing out of the business. So next up in this section, let's introduce the idea of payroll. Payroll is the system every business uses to calculate and record what they're paying to their employees. It includes things like salaries, wages, bonuses, and deductions, but it's much more than just handing out pay slips. Payroll is a vital accounting record. It's a source document that shows how much a business spends on its workforce. For businesses, maintaining an accurate payroll isn't just good practice, it's essential for meeting legal obligations and keeping employees happy. So, what information does the payroll include? It records all the financial details that appear on an employee's payslip, and it captures both what the employee receives and what the employer must pay on top. So let's start with what information is included in the payslips. You've got gross pay, which includes the employee's salary, bonuses, and commissions. From that amount, several deductions are made. These include PAYE income tax, which is withheld by the employer and passed on to HMRC. You've got the employee national insurance contributions, which help fund the UK's public services and social security. And finally, if the employee contributes to a workplace pension scheme, the employee's own pension contributions are also deducted from gross pay. So after these deductions, what's left is known as net pay, the actual amount that goes into the employee's bank account. We'll discuss net pay in greater depth on the next slide, but it's important to realise that payroll isn't just about the employee. It also includes the costs borne by the employer. For every employee, the employer must fund the gross pay due, but they also need to pay employers' national insurance, and often they contribute to the employee's pension too by making employer pension contributions. So all of the information presented on this slide is recorded in the payroll, which is in effect a detailed record of both outgoing payments and employer responsibilities. So let's take a closer look at how we get from the gross pay number to the net pay number. The net pay number is the amount an employee actually receives in their bank account on payday. Gross pay is the full amount earned by an employee before any deductions are made. It includes salary, bonuses or commissions, and when you start a new job, this is the amount that you'll be quoted by the employer as your salary. You're quoted the gross pay number. But employees unfortunately don't take home 100% of the gross pay number. Several mandatory deductions have to be made. First, as discussed on the previous slide, there's PAYE income tax. This is the tax deducted by the employer on behalf of HMRC. Then comes the employee national insurance contributions, which help fund things like state benefits and pensions. And finally, if the employee is part of a workplace pension scheme, they also contribute a portion of their pay into that. So what's left after these deductions is what's called net pay. And that's what actually lands in the employee's bank account on payday. This is the cash they receive from their employee from their employer in their bank account. So while gross pay might sound quite impressive, the true take-home amount the employee receives in their pocket is always lower, and payroll ensures that everything is accurately recorded in the business's records. So now that you've seen how gross pay turns into net pay for the employee, let's switch perspectives and look at what the total cost of hiring employees is to a business. And it might surprise you, but the cost of employing someone for a business is higher than just their gross salary. On top of gross pay, employers are legally required to pay employer national insurance contributions. And if the business has a workplace pension scheme, which most do, it's compulsory under automatic enrolment, they also need to pay employer pension contributions. So when you add these figures to the employer's gross pay, you get what we call the total payroll cost. So the formula looks like this: total payroll cost equals gross pay plus employer national insurance contributions plus employer pension contributions. And understanding this total cost and what it represents is vital for a company's budgeting, forecasting, and assessing the true cost of its growing workforce. Payroll gives a business this full picture. The key takeaway from the past couple of slides is that businesses that hire employees must pay more than just gross salary. So let's put our payroll knowledge that we've accumulated over the course of the last few slides into practice with a real world example. So say hello to Aisha. She works for a creative company called Greenleaf Designs Limited. Aisha's gross monthly pay is £2,800, but that's not what she actually receives in her bank account. As we've discussed, on payday at the end of the month, several deductions need to be made before that money hits her account. We're provided with the following payroll data, and we've been given two tasks. One is to calculate Aisha's net pay for the month, and our second task is to calculate the total cost to Greenleaf of employing her for the month. So we know the following. The PAYE charge for Aisha is £420. And in terms of national insurance, Aisha pays £230 and her employer, Greenleaf, pays £295. And in terms of contributions into her workplace pension, Aisha contributes £140 herself, while her employer contributes £180. So let's work through both of these problems on the next slide. So let's start off by thinking about how we calculate Aisha's net pay, the actual amount she receives in her pocket at the end of the month. So we start with the gross pay amount of £2,800, and we'll run through the deductions one by one. So first, £420 is taken out for PAYE income tax. Then £230 is deducted for her national insurance contributions, and she also contributes £140 into her workplace pension. So we take her gross pay at £2,800 and we subtract all three deductions. So £2,800 minus 420 minus 230 minus 140 is £2,010. That means Aisha's net pay for the month is £2,010. Now let's look at what it costs Greenleaf to employ Aisha. So on top of Aisha's gross pay of £2,800, the business must pay £295 in employer national insurance and £180 in employer pension contributions. So the total payroll cost to the employer is £2,800 plus 295 plus 180 equals £3,275. So while Aisha receives just over £2,000 in her bank account, at the end of each month, the company pays over £3,200 to employ her. Payroll makes these numbers transparent, ensuring both the employee and the employer understand exactly where the money is going. So let's test your understanding of everything that we've discussed in the payroll section with a real-world payroll scenario. So Bright Tech employs 4 members of staff in the year 2001 their payroll summary looked like this. The company paid a total of £120,000 in gross wages over the year. Employees received £91,000 in net pay. The employer contributed £5,000 to their pension scheme, and the total payroll cost to the company came to £135,000. And also importantly, there were no pension contributions made by the employees themselves. So based on this information, how much did Brightech pay to HMRC in income tax and national insurance contributions during the year? When answering these sorts of questions, you need to think carefully about what's going to HMRC. So what goes to the taxman includes PAYE income tax. It includes employer national insurance and employee national insurance. So that's basically what we've been asked to solve for here. We need to calculate and determine PAYE plus employer and employee NIC. That's the total amount that's going to HMRC. So pause here if you'd like to solve the problem yourself, and if not, let's break the question down together. So first, let's work out the total deductions from employees to see how much tax was paid. So we need to calculate the difference between gross pay and net pay. So gross pay is £120,000 and net pay is £91,000, which equals £29,000. So that includes both PAYE and employee NIC. And we're told in the question that employees don't make any pension contributions. So employee pension contributions equals 0. So this 29,000, which represents the deductions, the three deductions, only comprises PAYE and employee NIC. So we have two of the three things we need here. We just need to work out what the employer national insurance contributions are and add that on top of the 29,000. So to do that, we take total payroll cost and we deduct total gross pay which equals 15,000. And we know that the difference between total payroll cost and total gross pay is employer NIC and employer pension contributions. And that equals 15,000, so that's the difference. That's the two adjustments that get you from total gross pay to total payroll cost. And we know that employer pensions equals 5,000. So employer NIC equals 15,000 minus the employer pension contributions of 5,000 equals £10,000. So we have everything we need. In total, Brightech paid to HMRC is 29,000 plus 10,000 equals 39,000. That's the total amount that Brightech paid to HMRC. The PAYE, the employee NIC and the employer NIC added together equals £39,000. So the correct answer to this question is A. Well done if you got that right. It's not an easy question. These scenarios take a lot of practice, so practice applying the formulas, and over time, they should hopefully become a little bit easier.